Hi friends, welcome to this video. In this specific video, we are going to see what is a mutual fund, how to choose a specific mutual fund, and then finally to buy it. So all these things we are going to see in specific video and much more about mutual fund to suit your need. So continue watching. In the past, I have made multiple videos, and each and every video I have emphasized specifically on equity investing. And within equity investing, I have emphasized more on direct stock picking, how to filter out stocks, how to evaluate them, what are the different ratios we can use to select stock so that we can focus on quality companies over a long duration of time. And as we are all aware of, equity investing is the asset class which can help us achieve returns of 12% and more. It can help us achieve even 12% compounding year on year. It is the asset class which beats almost every other asset class available in the market today. But nevertheless, direct stock picking is not meant for everybody because of time constraint, of course. If learned and if you have the time, you can as well do direct stock picking. But however, if you don't have the time, specifically for working professionals who are in the 9 to 5 job, they need to spend almost like 12 hours in the job per day. So how do we expect to find time by then? So for them, we have an alternate asset class which is mutual funds. So in this video, we are going to see what is a mutual fund. We are going to see the different types of mutual fund. That is the second topic. We are going to see the third topic, which is the tax implication on mutual fund. The fourth aspect, we are going to see the criteria which we can use to select mutual fund. And finally, the fifth topic, we are going to see how to buy mutual fund, what are different channels available for buying specific mutual fund. So continue watching on. We are going to move to our first topic. So now we are going to see what is a mutual fund. Mutual fund क्या है हम देखने की कोशिश करते हैं अभी. So as you know, direct stock picking is as an individual, I need to devote my time. I need to spend time to pick companies, do the valuations of the companies, and then pick up the stocks myself from the market. Now, if I don't have the time, if I'm working professional, spending so many hours a day, need to devote time to family as well on Saturday, Sunday, I don't to do this analysis, paralysis. So we need to have an alternative for working professionals. So the alternative is mutual fund. So this mutual fund is something which is managed by somebody called as a fund manager. So this fund manager is much more qualified than most of the retail investors. So what happens in the case of a mutual fund is we have a lot of retail investors who want to participate in the stock selection but don't have the time. So because they don't have the time, they entrust the money or the capital which they have to somebody else who is called as the fund manager of the mutual fund house. So once this money is allocated to the mutual fund house, the fund manager takes the money and then using that money, using that capital, he has his own set of processes which needs to be followed to pick up companies, to evaluate companies, and then he himself will pick up the stocks and review on a daily basis or quarterly basis based on the different criteria used by the specific mutual fund. So now it is almost the same aspect what an individual would have done, that is done by the fund manager and in much better way. So that is about what a mutual fund is. A different collection of people coming together, pulling money, fund manager takes the money and then invests into different companies and creates your portfolio of stock which is seen as a single mutual fund name. So now that we have seen what is a mutual fund, we are going to see the second aspect, which is how many types of mutual funds are there. So the second aspect, which is the different types of mutual funds, there are a plethora of different types of mutual funds available in the market today. But to keep it simple, on a very broad level, there are three types of mutual funds. The first type of mutual fund is equity mutual fund. The second is debt mutual fund, and the third is hybrid mutual fund. So now equity mutual fund is clear enough. Equity mutual fund will invest most of the capital provided by the retail investors into stocks or companies. Debt mutual fund, whatever capital is allocated to the fund manager, they will allocate that fund to provide loans to the company. And this loan, the interest which is paid back by the company is given to the retail investors. So that is about debt. And hybrid, of course, is a mixture of equity and debt. So now there are different ratios of hybrid mutual fund. Some of them could have 65% of equity. Some of them could have like 35% of equity. Based on that, your tax implication would arrive to. Other than equity, debt, and hybrid, within equity, there are different classes of mutual fund as well. In a broad level, there is a large cap mutual fund which is less riskier, which is more stable. We have mid cap, which is slightly more riskier than a large cap. And then you have finally small cap, which is much more riskier than a large or a mid cap. And the returns provided by each of these categories varies. So the stability of a large cap is much better, but the returns is equally comparatively lesser than mid cap. It could be like for a large cap you would expect a return of 12%, for a mid cap you would expect a return of 13%, and a small cap you could expect a return of 14%. These are average returns. You could expect even more. This is about equity. Within debt also there are different classes of mutual fund. Beyond the topic of this specific video, we are going to see a different video different video for debt and hybrid mutual fund in the subsequent video. Now let us see what are the tax implications for mutual fund. Of course, the tax implications would come only when you sell the mutual fund units. और कौन बच सकता है टैक्स से कौन बच सकता है? So but one good point about mutual fund is that you don't have to pay your taxes according to your tax bracket. But nevertheless, if you don't fall in any tax bracket as well, you need to still pay tax on your mutual fund when you sell them. Of course, there are some certain other rules depending on your max chargeable income and those factors which you can check with your tax advisor. But nevertheless, for those people who are in a tax bracket of 10, 20 or 30, the tax implication for selling mutual fund is this. For a short-term mutual fund selling, which is less than 1 year, which is classified as short-term capital gain, the profit made after deducting the cost of whatever you would have spent on buying the specific mutual fund, the profit, on that profit you will have to pay today 20%. Earlier it was 15% in the previous years. From now on it is 20% for short-term capital gain. And this is for equities mutual fund. So now when you come to, if you have invested more than a year in mutual fund, in equity mutual fund, then it will be classified as long-term capital gain. So when you sell them, whatever capital you derive after you sell, it will be deducted from the cost of whatever you have invested, and the profit which you derive, you will be taxed on the profit amount. So now in case of long-term capital gain, it is 12.5% provided the gains is more than 1.25 lakhs for that specific year. So up to 1.25 lakhs, chill. You can enjoy without any tax on 1.25 lakhs. And this is irrespective of your tax bracket. Even if you are in the 30% tax bracket, you can enjoy the gains of 1.25 lakh. You can sell equity in your account and plus your wife's account, then you can get a gain of almost 2.5 lakhs tax free. And then you can even put some amount on your kids' name if they are beyond 18 years. So isn't it wonderful? you can have your family of 4, you can have 5 lakh additional tax gains, tax free gains. So beyond 1.25 lakhs, you'll need to pay tax, that is 12.5% on the profit. So let's take an example. Let's say you have invested 100 rupees to buy the specific mutual fund, and you have sold it later on before 1 year completes for 200 rupees. So now because you sold it for 200, the gain is 200 minus 100, which is your profit. So 100 rupees is your profit. On 100 rupees, you need to apply 20%. So that is 20 rupees you need to pay as taxes to the government. Here there is no exemption. On short-term capital gain, there is no exemption. On long-term capital gain, if you have kept this mutual fund for more than a year, and if you have still managed to sell it for 200 rupees, then the profit, which is about 100 rupees, you have to pay 12.5%. Now remember, up to 1.25 lakhs is still exempted. So this is a short example. If you are still doubtful on an example, please drop a comment. I'll explain in more detail. So now that we have seen the tax implication on mutual fund, let us come to our fourth point. So now let us see what are the different criteria which we can use to qualify the mutual fund which we want to invest our capital into. Now for direct stocks, we have a plethora of ratios, plethora of valuation method. It's very complex. But however, when it comes to mutual fund selection criteria, it's very simple. Just top 5 criteria which I'm going to explain in a specific video. Now if you have a financial planner, financial advisor, you can rely on them. But nevertheless, if you know the 5 criteria, you yourself can as well do some research before you rely on a financial planner or a financial advisor. So let us see the first criteria. The first criteria is, of course, we want returns. So higher the return, higher the long-term returns of the past, we can hopefully expect the similar returns for the similar duration in the future. Nevertheless, it's not guaranteed, but it gives us a benchmark, it gives us a stability, it gives us some comfort before we want to invest our capital in the mutual fund. So long-term historical returns, which is the first criteria. The second criteria, we need to see who the fund manager is. What is the historical performance of the mutual funds for which that fund manager was assigned. So better the performance of the mutual fund for that particular fund manager, you can select the mutual fund for that specific fund manager and list it out. So this is the second criteria. The third criteria is the company size, the mutual fund company size, the asset management company size. Now every mutual fund has an asset management company. For example, the top 5 asset management companies is decided based on the fund size, depending on the faith of a lot number of people to give the capital to that mutual fund house. The topmost is actually SBI, State Bank of India. The second, State Bank of India was the first. The second is ICICI. The third is HDFC. The fourth is Kotak. And the fifth is Nippon. So you need not restrict your investing to the top 5. You can go beyond top 5, which is the top 10, provided you don't skip the earlier 2 ratios as well. So now that we have understood the third criteria, which is the asset management company size, let us see the fourth criteria, which is a little more additional in terms of ratios. So we have just about 3 to 4 ratios which we need to be concerned about. The first ratio is about standard deviation and beta, which is going to help us determine what is the riskiness of that particular mutual fund. How risky it is with respect to its average returns. So high the standard deviation, the volatility with respect to the average return is going to be very high. So your duration need to be very long so that you can absorb that risk. But if your duration of investing is small, like 5 years, you can't afford too much high standard deviation or beta. So you need to select a standard deviation which is adjustable to your specific goal. So standard deviation along with beta, and then you have Sharpe ratio, which is basically about the amount of risk taken. For that specific amount of risk what the fund manager has taken, what is the returns it can generate for that specific risk. So higher the Sharpe ratio, positive Sharpe ratio is better compared to a zero Sharpe ratio or negative Sharpe ratio. Then finally we have the Jensen's alpha, which is the additional returns for which that mutual fund can generate over and above the benchmark mutual fund. So these are some of the ratios which you need to take care of. You need to filter out on these ratios to select your mutual fund which you need to put your capital into. So which is the final criteria? You need to decide upon whether you want to invest in direct or regular. So regular is you need to pay commission to the broker. In case of direct, you need to pay very little fees, but there is no brokerage or commission involved. So the difference could be easily 1%. So in regular, you expect the mutual fund house will deduct 1% additional compared to a direct mutual fund. So which is quite significant if you're going to invest for more than 7 years and beyond. So now that we have known the 5 criteria, I hope you're all set to now buy the mutual fund. So let us see a final topic of how we can go and buy the mutual fund. Now let us see how to buy the mutual fund. अभी हम देखेंगे म्यूचुअल फंड को कैसे खरीदा जाए. For buying mutual fund, there is old traditional method as well as modern methods. In a traditional method, you visit the bank, you fill a form, and you give the capital in different forms, and then the person sitting at the desk will give you a receipt of your investing. That is the traditional method. But if you want to use the modern method, there are different platforms available. There is CAMS, there is Grow, there is small case platform available where you can invest your capital. It's just a matter of having your Aadhaar card easily available as well as your PAN and your bank account details available. You need to log in, you need to register using all these documents, and there you go. Your account is ready to buy a mutual fund. Now when you buy a mutual fund is associated with a NAV, net asset value. Like how a stock price has a price associated with itself, every mutual fund will have a NAV price. Now depending on the number of units you want to buy, for example, the NAV of the particular mutual fund is about 15 and you want to buy 100 units of that NAV. So that means 100 into 15, which is 1500 rupees. This is the total amount which you need to be keeping ready in your bank account so that you can invest into the specific mutual fund. Now when you buy a mutual fund, there is a minimum starting investment which you need to do. Sometimes the minimum starting could be 5,000 depending on the type of mutual fund. Mostly debt mutual funds have the minimum criteria of 5,000. But equity mutual fund, I believe, can offer as low as even 500 rupees to start off with. So you can choose your comfort level. You can browse to which are the mutual funds which are giving you a startup, the initial cost which is involved to put your capital. But nevertheless, you need to keep the initial minimum investment amount available for you, and then subsequent investment can be of a smaller denomination or smaller amounts. It could be as small as small as the NAV. The NAV could be like 15 rupees. You just even put 15 rupees to buy a single unit. But the initial amount can be higher than the NAV. So this brings us to the completion of understanding of mutual fund. That is one aspect which I want to share in this specific video, that is about ELSS mutual fund, which is the fourth category of mutual fund which was not covered in the type of mutual fund. So let us see a brief about ELSS mutual fund. So ELSS is equity linked savings scheme. So this is another category of mutual fund which comes within the equity category of mutual fund, which provides tax benefits as well. Now this tax benefits or tax deduction of up to 1.5 lakh can be availed provided you are on the old regime, but in the new regime you can't avail the benefit. But does that mean now you sell up all the ELSS units and buy other mutual funds? Well, it has to be a calculated call. You need to check. You need to remember that for ELSS you need to have a locking period of 3 years. Only after 3 years you can withdraw from that ELSS fund. It also depends on the performance of other mutual funds. It depends on the risk you can afford to take in the other mutual funds. Because ELSS, when I have specifically checked, has lesser risk than compared to others because it has a lock-in of 3 years. You don't have too much volatility then. So suit yourself whether you want to continue investing in ELSS and keep the old or the new tax regime selection different from your investing profile. So now that we have seen different aspects of mutual funds, we have covered what is a mutual fund, we have seen the different types of mutual fund, which is the equity mutual fund, debt mutual fund, hybrid, plus we have seen ELSS at last. We have seen the different criteria which we can use to select that mutual fund. We have seen how we can approach to buy the mutual fund. So now that we have covered every aspect, if you have still questions available on whether you should invest, which are the mutual funds you want to invest into depending on your goal, please drop in a comment and I will respond back. So happy investing to continue to grow your wealth for each and every of your goals. Do read my book on investing. It's more about how you can pick up direct stocks. It also gives some suggestion of an alternate approach other than direct stocks. And the stocks which I have suggested in the book, that is Dodge the Recession, is more on investing altogether. It shows you what kind of portfolio allocation you need to have. So definitely it's going to be of help. It's a very easy to read language. It's a very easy to follow process which you can follow any year, any time of your career. You can read the book, and if you have any questions on the book, please reach out to me.